I don't think I'm going to reiterate that too much. You've probably heard more of it than you want to. I mean, I'll touch on the high notes or the low notes, if you will, because they feed into some of the other stuff I'm talking about. Washer, flying kitchen sinks, they're going to throw everything at this sucker. Washington, Brussels, London, Tokyo, you name it, Beijing. Whether or not you think it's a good thing, and you can certainly make an argument it isn't, you're going to probably see the biggest, probably the biggest Keynesian spending expansion / monetary expansion in the history of the universe in the next year or two. I think these guys are probably just warming up. You can certainly make an argument it's not the right way to go, but it's the way they're going to go. And I think we got to deal with what's happening rather than what should be happening or what might happen. To give you some idea where we're at, this is a very interesting chart, even though it does kind of look like a plate of linguine. John Husband put this together and lent me a copy. What this is all of the bear markets, basically since World War II. The first thing you'll notice there's actually been a lot of them. He's just using the standard 20% drop definition. It just basically traces the path of each bear market from the top to the bottom, so they don't go any farther than the bottom, essentially. This is the one that we're in now. He did this chart in October. I haven't been able to talk about an updated version. That shows this spot right here is about where we were in October. It then went down to about here. Now we're back about here. The reason why I show this chart is it's an interesting example. I mean, we all know how deep it is, but I think the examples that you've got to be mindful of is this one here, which was the last bear market at the end of 2000, 2003. That's this line. And then the other one that had some actual length to it, if you will, is back in the mid-70s. That's this one here. I mean, these ones, as you'll note, obviously the big difference is the duration, not just the depth. And the reason why we use this chart is to point out this in particular. This is a pretty common feature for any of the longer bear markets, is that the bottom gets tested 2 or 3 times. The bottom that doesn't mean the bottom won't hold. It just means it's likely to be tested. My gut feel, and I can't say it's any more than gut feel, to be honest, is that the bottom in March is probably going to hold. I think we're going to get close to it. We might get close to it a couple of times. Part of the reason for laying that chart out first is it's just a general way of saying, you know, there's going to be more trains coming through the station. If you missed something a month ago, don't start trying to chase stuff up here. You got to be taking profits until we're all comfortable that we've cleared the decks and we're into a new bull market. There's nothing wrong with taking profits and coming back later. And if you miss a few percent on the way up, you're probably better off to miss a few percent on the way up in a spot like this than not do it and end up sitting here again going, why the hell didn't I sell that stuff? Credit was the defining factor of the last 2 Anglo-Saxon booms, and I use the phrase Anglo-Saxon quite specifically because it was really the States and Britain, you know, Canada to some extent, but a much smaller one. But it was really a U.S. British thing. Most of the European banks, to their dismay, now came in later. It was about credit. It was, in fact, if you take a look at the growth in the U.S. economy from 2000 to 2007, if you strip out basically expenditures that were due to pure credit creation, that's like REFI activity, home equity loans, that sort of thing, you go from an average growth of about 3.5% to an average growth of about 0.5%. In other words, the last economic cycle and part of the one before it were really about credit growth, pure and simple. Now it's just turned into a bit of a nightmare. How big a nightmare, nobody knows. I don't think most people that know me outside of my day job, which is this, would think of me as an optimist, but when I do this job with a bunch of other guys, I feel like I'm the optimist most of the time. I'm not sure what all of this structured credit junk is going to be worth at the end of the day. I certainly don't agree with the guys on Wall Street that it's going to be where they're booking it at, but I also don't agree with the pessimists that it's going to be where it's trading at right now. I think it's fairly unlikely you're actually going to see 70 or 80% write-off rates in U.S. mortgages as an entire market. That's fairly unlikely. I mean, I won't bore you with the details of how this stuff gets structured. There are tranches in each one of these things that are toast, and that's what's driving the prices down. But I suspect at the end of the day that you know, the bill that we're all going to be saddled with will probably be in the order of 3 or 4 trillion. That's my best guess. And I don't think anyone's got anything other than a guess. This, of course, is where we've been and where we're at right now. I throw these two charts up simply to point out that, I mean, I live on the other side of the 49th parallel, and as it happens, a lot of the companies we deal with, because we deal with resource companies, I mean, they tend to be listed on Toronto. If you take a look at the difference between these two, really, Toronto started coming off a lot later because commodity prices actually held on a lot longer than other asset prices did. They were really the last asset category to start falling off. Toronto's all-time high is right about here on this chart. S&P's is like way over here someplace. They both had about the same bounce. Toronto has a lot of oil companies on it, so the bounce in Toronto is actually relatively understated because the oil sector and the oil and gas producers on Toronto has gone essentially nowhere in the last 2 months. Basically, most of this bounce is the banking system. Canada actually has one still, and basically the metal producers and the gold producers. You know, as much as I know that it's very easy to fall into the trap, and it may, you know, maybe at the end of the day these guys will turn out to be right. Maybe the world's going off a cliff. I think it's going to feel like it, but I don't think it's actually going to happen. I don't think you can understate this. I mean, there's nothing on the scale of this stimulus that's ever been done in history, even remotely close to this level of stimulus. A couple of things that have to happen is we do have to have these macro adjustments, and a lot of those are things like changes in real estate prices, changes in the bond prices. I mean, I've got one foot in the school of some of the guys that I know have spoken here that would just like to see some of these banks go under. I'm not totally comfortable with that concept because of the panic it's likely to cause, but I do agree with the sentiment behind it, which is basically a lot of this stuff has to get written off. You've got to get clearing prices on this stuff. At the end of the day, you just have to get past it. You don't get past it without writing it off. And it's time for the U.S. in general to say, okay, who ends up holding the tab for this stuff, and how much of this can we write off and just get it done, just get it over with. Because a lot of this stuff's not going to get paid anyway, so let's, you know, why drag it out for 10 years? We might as well just deal with it. The important thing, though, as painful as that's going to be, I mean, the process has started. This is going to be has already had a big impact on some of the metal markets. It's going to have more, and I'm going to go into that a little bit more here in a minute. This is basically what you've got to deal with. This is a Morgan Stanley chart. This is basically U.S. debt levels for different parts of the economy: household, corporates, financial, GSE, government. Government, obviously, this chart actually goes up to about the end of 2008, but most of the spending actually isn't in this chart. So the government one's probably up around here now. This one is starting to fall off, which is actually a good thing. Corporate, and it's one thing to keep in mind, is outside of the financials, the corporate sector is actually in pretty good shape in North America. Most corporations actually have better balance sheets than people give them credit for. They actually spent a lot of time writing stuff off, and they did have, after all, 8 or 10 pretty good years before things went for crap here in the last 6 months. So there are actually a lot of sectors, although they don't look that way in the stock market, they do actually have room to do stuff when they feel like they've got a market to deal with. This is probably going to be one of the defining factors in the next 10 years, and it's an important one. This, of course, this is the personal savings rate. This goes back to 1960. About 1982, it started to fall off. The way these guys calculate it, I mean, they show it being just over zero. That's, in my opinion, probably an overestimate. It was actually below zero, in my opinion, and probably dropped below zero around here at some point. But the important thing to note is how fast it started to pick up here. And this is basically just the process of households fixing their balance sheets, and this is a process that's going to go on for a while. This is what the other end of the credit cycle looks like. You know, stuff gets written off, people decide they have to increase their savings rate, they cut their debt down, they start trying to build up savings. All of that's a good thing at an individual point, but it brings up what economists call the paradox of thrift. It's great if you're saving money, it's not so good if everybody else is, because the money they're saving they're not spending on stuff.